Hello there. I am Dr. Redwan Sukariao. I am an assistant professor in finance at Edinburgh Napier University Business School. Today, I'll be discussing our paper in British Journal of Management. The title of the paper is The Impact of Government Policy Responses to the COVID-19 Pandemic and BREXIT on the UK financial market, a behavioral perspective. So we want to talk about how investor sentiment based on government policy responses to the pandemic and Brexit affected the United Kingdom's financial market. So I'll give you a brief background to the study. The COVID-19 pandemic came with so many disasters, with more than 300 million confirmed cases and about 6 million related deaths as of December 2021. The damaging impact of COVID-19 pandemic has literally been experienced by almost every part of the world. Research shows that the pandemic disrupted nations significantly, although differently, as both public and private entities have had to either shut down operations or downsize their workforce. Across global financial market as well, the effect of the pandemic on investors' wealth took diverse perspectives. For instance, research shows that stock markets in Europe, Asia, and North America were severely hit by the pandemic, while stock markets in Africa were not so impacted compared to other parts of the world. So essentially, the cost of the pandemic to countries varies with the level of exposure of their financial system to external shocks and the immediate policy responses to cushion the effects. So despite the countrywide variations in social and economic restrictions during the pandemic, the global stock market still shrunk by almost 30% in value. That's according to the World Bank. And this raises concerns as to what factors influenced the behavior of the market during the pandemic. In our study, we hypothesized that investor sentiment could be a significant determinant. And as a result, we analyzed the role of sentiment factors on the financial market, particularly the UK market. Furthermore, we hypothesized that during the pandemic, there were varying stages of social restrictions imposed. These restrictions came with boredom, and in fact, it improved disposable income of those working from home. However, due to these social restrictions, investors relied on government announcements periodically to make crucial investment decisions. This also increased the use of social media, not only for entertainment purpose, but as a source of reliable information. Consequently, we opine that the emotions and moods of investors towards the financial market might have been impacted by the information they obtain from social media and other news outlets. Also, our focus on the UK market is not unconnected to the global statistics and report on the pandemic. According to the Coronavirus Resource Center at Johns Hopkins University, by the end of 2021, the UK had the highest number of confirmed COVID cases, as well as the highest death toll. It had the highest number of confirmed COVID cases in Europe, as well as the highest death toll in Europe. About 12 million cases were recorded in the UK, with more than 150,000 deaths, and this was the highest across Europe. Again, we use the UK market because of the relationship between the EU and the UK in recent times. So the pandemic came at a time when the UK was exiting the European Union. Considering that the European Union is the UK's largest trading partner, we feel that the final exit of the UK from the European Union at a time when the COVID pandemic was intensely ravaging all sectors, could only be double jeopardy for the UK economy. So, how did investors react to this double situation of the pandemic and Brexit? So, this is another motivation for our research. Considering that the investors in the UK were concerned with the magnitude of the impact of Brexit on their portfolios, and in light of its concurrence with the pandemic, we feel that our study comes at a crucial time when the world is witnessing another episode of the pandemic, as we've recently seen in China. So our study addresses pertinent issues surrounding the behavior of financial markets and provides valuable information to regulators and other stakeholders in the market. We used a couple of theories in our study. We used the adaptive expectation theory, bounded rational theory, prospect theory or loss aversion theory. We also used the theory of noise trading, investor recognition theory, ambiguity or uncertainty aversion theory, as well as behavioral portfolio theory. So on account of the foregoing theories and the background to the study, we contribute to the literature in the following ways. First, we provide empirical evidence of how financial markets, particularly the UK market, responded to the concurrence of the pandemic and Brexit using both returns and volatility of the market. This is particularly important given that prior studies in the literature have used returns and volatility of just the capital market to measure the impact of the pandemic. We suggest in our study that the importance of money market in financing domestic and foreign trade, as well as maintaining financial stability, cannot also be downplayed. So we used both the capital market and the money market in our study. More so, not just the capital market came under severe stress, not just the capital market was impacted by the pandemic. We also saw that money markets across the globe came under severe stress during the global pandemic. Therefore, we examined the impact of the pandemic and Brexit on both the capital and money markets, and our result shows that the pandemic has significant effects on both markets. Also, in contrast to prior research on the pandemic, our study uses investor sentiments to explain how the pandemic affects the entire financial market. Prior studies have used macroeconomic indicators. In our own study, we used investor sentiment, and our sentiment measures are unique set of data sourced from the social media and government periodic announcements. So in our study, we used an index of these indicators to explain how the outcomes of the market were impacted by these sentiment measures. Again, we developed a principal component analysis to create new pandemic and government response indices, and we independently test these indices on our financial market data. This is important given that prior studies in the literature, like I said earlier, have used various measures of the macroeconomic indicators to explain how the pandemic affects the financial market. But in our own case, we're using a unique set of data comprising of new government response indices and pandemic response indices. And lastly, in order to test how various sectors in the UK reacted to the effect of the concurrence of Brexit and the pandemic. We used systematic risk of the sectors within the UK stock market to explain how these Siamese twins, as I'll call it, the pandemic and the Brexit, how they played a major role in influencing the outcomes of some of these sectors. So the reason why we did this was to allow investors have a better understanding of their decisions in case they want to make any strategy in terms of diversification or portfolio allocation. They will have a clear understanding of how each sector is impacted by the Brexit and pandemic. So generally, our study provides valuable information to government regulators, to practitioners in the industry, as well as the academic community. Thank you very much for your time, and I hope you enjoy reading the paper when it is eventually published. Thanks.